And we're live. We're live on Tuesday. And in case you were wondering what I was holding in my thumbnail, this is actually a barometer from a ship. I bought it off eBay, just like I bought most of my antique collection, the old Philco radio, some of those wax cylinders. Um, the barometer doesn't work anymore. I used to think that this actually worked. In case you look at this, right? I mean, some of the readings are super interesting, right? I mean, um, would work off air pressure, and so it would tell you, what the weather, I guess, is going to be, or so. Yeah, I mean, I think kind of like Wall Street kind of does this to us, by moving prices around, right? I mean, sort of like a barometer. This barometer I can control. And yeah, I was sort of like thinking through some of this for today's live stream, which is that there was something that happened. It came out last night in Japan. And the moment I saw it, I'm like, this seems small, will probably be disregarded, but in the long term is going to matter, and matter in a very big and significant way, because it is another point of confirmation that we're in a different moment in time, and the markets are set up like they're backward looking. In other words, the world of wishful thinking is always like, hey, we understand the past, let's bet for that. And that's the way the markets are set up, and they really don't take into account where we are going. And in this live stream, I want to talk about how the markets are positioned. First, I'll talk about what happened with Japan, why it's important, how the markets are sort of like really completely not positioned for this, which is not unusual at the beginning of inflection points. There's a lot of confusion. Obviously, the future, there's no facts, right? I mean, you have to bet on something that's a blank slate. And then I'm going to talk about like where I believe that, markets are going, and stock markets, crypto markets, financial markets. I'm then going to give you some examples of like places where I believe that, when you look back, these are the places where you're like, yeah, that was very clear. And we had, this trigger point, okay. But before I do all that, very quickly, all the usual things that I usually do, which is tell you that this live stream and the content from ATG Digital Media, which is my company, is not investment or financial advice. It is presented as opinion, information, engagement, and entertainment. Next, all ATG digital content may have errors, oversights, or mistakes. So, you can't just be like, oh, well, Paul said it. I was going to go bet the farm on it. Yeah, don't do that. Stuff can be wrong. Make sure you check all of our work. Understand that investment operations, which is what? Well, buying and selling a stock, crypto, options, they have significant risk, can lead to the loss of your principal. So be careful. Last, the owners, employees, contractors of ATG Digital Media, we own, trade, transact, and securities that are mentioned in this video, and any of the content that we put out, our updates, our model portfolios, our trades, et cetera, et cetera. Next up is just a rolling ticker of all the free content. The Substack is daily. It's completely free. We don't charge for the Substack. The podcast is free. I've been doing, I don't know, like 1 or 2 a month. It's kind of like spotty. YouTube, I'm on, at least once a week. Then we got social media. X, very active. I really highly recommend that if you find my viewpoints, opinions, facts, evidence interesting, follow me on X, because I put stuff out there often first. Like I think through some of these things on X first. And in fact, today's live stream sort of like really comes out of something I put on X this morning. Finally, if you want to become a subscriber of ATG Digital Media, that is our website, atgdigital.media. That's where you can go. Subscriptions start at $9.99. All right, let me see if I can get the tweet up and show you what I mean by, yeah, this is the one. that I'm referring to. So you'll see here, markets are positioned as if we're going to see a replay of 2009 to 2021, ZERP, LERP, and I forgot NERP. What are all those abbreviations? Well, NERP, which I didn't put in there, would be negative interest rates. ZERP would be zero interest rates. LERP is low interest rates. And then I talk about Bank of Japan as the latest signal that this is wrong. Folks should be positioned in assets whose value rise under inflation. I call scarcity assets. All right, so let's just go back a step and talk about what happened yesterday. All right, that's point number one, which is that the Bank of Japan raised interest rates, and they raised them by like nothing, like 0.1%. And most people are gonna be like, no big deal. All right. I'm gonna say, yeah, not a big deal today, may not be a big deal tomorrow, but will be a big deal with each passing day that happens. Why? Well, Japan was the last major economy that was left to stop one of those three abbreviations: NERP, negative interest rates; ZERP, zero interest rates, low interest rates. So they finally are no longer in the world of negative interest rates. And why does that matter to you? Why does that matter to US financial markets or global financial markets? Because you know what? The world is global. If you are a major company, you could go to Japan and borrow at those crazy low rates and do whatever. You could obviously fund an expansion in the United States, fund an expansion in Japan or some other part of the world. You could move the money to different places and buy back stock, and by doing various financial manipulations, pay out larger dividends. So, well, the last place where negative interest rates were available is now gone. And while they have lifted rates to this tiny number, that's really not the big headline. The fact that you can no longer borrow and give less back in return, that is just no longer available, which means there are a lot of investment strategies that are keeping our markets and the prices of stocks, for example, bonds, other assets high, that are dependent on these, NERP markets, negative interest rate markets, zero interest rate markets, and it's now gone. We haven't yet seen an effect. Why? Well, that's because, markets, this is a big shift, and you're not going to have everybody simply disengage all of their strategies, like that. Hey, we're going to just terminate everything in a day. That's just not the way, large companies work. It wouldn't be actually possible to do it. Plus, from their perspective, it'd be like, okay, well, the biggest issue that, companies that are borrowed, they're going to face is that, well, okay, we've got these negative interest rate bonds that we have to pay back. And if you weren't planning to pay them back and you thought that NERP, ZERP, LERP was going to exist in Japan for the foreseeable future, the next 5 years, 10 years, well, you've got the beginnings of a problem, which is that you got to figure out how to pay your, this bond back. You can no longer count on rolling it over. In other words, you're like, okay, well, hey, in 5 years, there'll still be one of these categories: NERP, ZERP, LERP, and I might take a small hit if it's low interest rates. But in 5 years, rates in Japan could be 2%, which doesn't sound like much, but right now it's 0.1%. So 2% from 0.1%, or if you were paying negative 1% or negative 2%, yeah, that's a big deal. Now you got to come up with 3 or 4%. And let's say you're a large company and you borrowed $100 billion, $200 billion, and you've been, counting on that free financing. Yeah, it's going to make a big difference, but it's not immediate. And you can understand why, because the bonds don't mature today. They don't mature next week, but they mature over time. And so over time, you will have this impact. And this signal from the Bank of Japan confirms something that I have been telling you in the ATG Digital updates. I first sketched this out actually in the Ballman Speculating podcast, which is that, in my opinion, in my judgment, we're in a completely different interest rate cycle. One interest rate cycle ended in, depending on when you want to count it, late 2020, early 2021, when the Federal Reserve started raising interest rates. And that cycle began in 1980, 1981, where interest rates start from a peak of something like, depending on what rate you look at, 16, 18%, and go all the way down to slightly negative. I mean, we had like, I don't know, a 6-month period when rates were negative in this country. But we are now on, like, I don't know what the time cycle would be, because it seems to vary based on my studies, but it's somewhere between 40 and 50 years is the interest rate cycle. And so if that is right, then rates are going to be much higher than what most people are expecting, anticipating, pricing, than any previous period that people are currently thinking about. Because most people that I read on X, which is like the place that most, I guess, opinions on finance, investing seem to put out, Reddit is a close second, seem to just be looking back and be like, hey, well, rates will go back down to whatever. Even if they don't go to 0, they're going to go to 1. They're going to go to 2 or 3. And most people have not done a broader sort of like look or study and said like, well, I mean, interest rates, go up and down over time. And there is a clear cycle where, yeah, you start from a high point and you get to a low point. And so if you go back from whatever, 1980, yeah, there's you can actually track this. And I've, put out a number of things both on my Substack and on X showing like, yeah, post World War II, we were at 0. We're at 0. And then by 1980, we're at whatever, 16, 18%. So there is a very clear cycle in which, it goes. And the behavior of asset prices at different parts of different cycle, I mean, are matter. Generally speaking, obviously, lower interest rates are friendly for asset prices. And that is what you have experienced if you've been invested in stocks, invested in bonds, invested in venture capital, invested in private equity, pretty much anything from 1980 on, with obviously lots of speed bumps along the way. Generally, price go up has been a good assumption. But if you go and look at the experience from 1940 to 1980, yeah, it is, price go up is not such a great assumption to make. There are periods in which price go up definitely happens. And then there are periods where like, whoa, for 10 years, you either had bad results or you had like, just nothing. It just stood flat. So in my judgment, many people are currently set up for rates to go lower. Why? Because that's what we most recently experienced. I mean, 2020, I mean, that, into COVID, for, rates to be cut almost like in an instant by, I can't remember, by 2 or 3%. And, that's what people are hoping for. And in this live stream, I'm going to lay out like, why that is. But if I were to bet, again, and I'm thinking always longer term and strategically. I'm not thinking for day trading. I'm not thinking for week trading. I'm thinking longer term and strategically. I would bet that the next big rate move is likely to be higher rather than significantly lower. And remember, I'm definitely using the word big rate move. So, where there's a series of moves up. And, so notice the verbiage, which is that you could still have slightly lower rates. I mean, I went and studied the 1940 to 1980 cycle. There was one brief period of 2 years where the Federal Reserve lowered rates. But other than that, generally speaking, in that rate cycle, it was a steady up, 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 up. We're quite different in this because the Federal Reserve has essentially kind of like captured something like, 28 years worth of rate increases in the space of 2 years. In the 1940 to 1980 cycle, it took them from 1940 all the way to 1968 to get to 5.3%. We did it in 2 years. I have then made the assumption that because of that, like we're likely to sit somewhere in this like 5 range. Maybe we'll go whatever to 6%. Maybe we'll go back down to 5%. We're going to sit in some range that's relatively stable. And that's the assumption that, I'm making when I talk about, anything in this live stream. So that's one big, thing that most people are not thinking about, not assuming for long-term investing and speculating. The third one is that when you read about analysis about inflation, there's a lack of common sense that is like written and talked about, which is like people talk about inflation as if like this can be like engineered by pushing some buttons. Hey, listen, you just think through this, right? Inflation comes about, right, and in this cycle, and really gets hard coded into our society, into our economy, primarily through what rising salaries, rising incomes, and that gets then embedded into obviously our expectations because nobody wants to step backward, right? I mean, you're going to volunteer for the good of the country for lower inflation to take less money when you go to work. Yeah, I don't see anybody wanting to do that. Equally, when you then think through on an economy-wide basis, right? Every company, as they go to contract with another company, whether it be a 1-year contract or a 3-year contract, they are locking in a series of price increases. I mean, they're like, well, hey, all my costs have gone up. I'm paying my people more. Every supply, everything that I buy, whatever business you're in, the prices are up 20 or 30%. Yeah, the new contract needs to reflect that. So inflation, higher prices is hard coded into our economy, which is, then reflective of the fact that it's like, we're in a rising rate environment because of this. Because despite all of our wishes for lower interest rates, yeah, every time we get CPI numbers, PPI numbers, they never quite come in like, we're never rolling the clock back. We never, we don't get like a negative 10% number to be like roll the clock back to 2019 before we had, the COVID inflation explosion. I mean, go and look through your refrigerator, go and look through rents. I mean, nothing has rolled back to 2019 or 2020. So those expectations, those prices are increasingly being hard coded into all of our expectations, all of our contracts, everything in there. So yeah, I mean, from here, this is the going assumption because why? Well, once you get that price, I mean, so every person that was hired for, let's say, 30% more, well, they expect whatever, 5% more. And inflation is going to be 4 or 5%. They'll be like, well, inflation's 4%. You need to give me 5, right? So there's a kind of like a lack of common sense thinking about like, what is really being wired into the economy, hard coded into the economy that you can't escape. And then extrapolating that to asset prices because, well, everybody works for one of these companies. Every contract is being done between, one company and another. So uh, if I, were looking at this, I would not be looking backward and say, hey, let me invest for low interest rates. Let me, invest for a highly active Federal Reserve that's highly supportive of asset prices. Yeah, that world is gone, folks. That world is, it's not gone. It's essentially, I mean, the Federal Reserve still has this bloated balance sheet of, I can't remember, 4 trillion with, lots of bonds and all these things, but they are slowly getting rid of it. In other words, yeah, I mean, this was, a period from 1980 all the way to 2021 where first interest rates went down, kept going down. Then we had, 2 crises where the government and the Federal Reserve got increasingly active. And now we are unrolling our way backward to a different world. And it's going to require a different viewpoint on the world, a different strategy set, different assets. And yes, sure, in any given day or week, people will point to, well, Paul, this stock that you said was not going to do well. It's up 30%. Hey, that's all great. Congratulations. Well done. We shall see. I mean, you can go and look at the returns of companies in the 1970s. I mean, they were pretty brutal. They had many good years, but still, if you were in it for some period of time, or if you got in at the wrong time and held, like either you had dead money and or you lost a lot of money, which now gets to the point of like, well, how are we positioned at ATG Digital Media? For those of you who are new and don't know what ATG Digital Media is or don't know who I am an ex-hedge fund manager. I've managed billions of dollars in, I hate to say it, 30 years in various capacities: analyst, portfolio manager, managing money, was in the what's called the newsletter business. So, I mean, there was a newsletter publishing industry that's out there. And that's where I had a fairly large following of 165,000 people, which is the basis of this channel, and ATG Digital, because my contract was terminated there. And actually, we got crowdfunded by our subscribers to continue our work. And that is the basis of ATG Digital. So that's just a very rapid introduction to me. You can obviously Google me. I have a fairly lengthy LinkedIn profile that you can check me out. All right, but getting to how should you be positioned for the future? And in my opinion, there is one thing that really should be the focus of every person that is investing today, and that is a focus on scarcity. Scarcity, because if you think about this, which is like, as money gets looser and looser with lower interest rates and, NERP, ZERP, LERP, et cetera, it can fund a lot of different things, right? I mean, you've got this idea, sure, here's money. You got this idea here, sure, it's money. But now as interest rates, are higher, the bar is just much higher for pretty much every single thing, right? So you got to look at, it's got to be scarce. So, many people will think like, well, inflation, one of the common ways that people think about inflation is think, well, I mean, focus on companies, for example, that can increase prices, right? But really, there's like more required here. It's not just increase prices, but you have to be able to increase prices while maintaining your profitability and without losing actually, all your existing customers, because there's a very natural thing that happens when you raise prices, which is, some number of people can no longer afford your product and they stop buying it. They will move to a competitor. They will substitute for it. They'll choose an alternative. So companies that can actually raise prices and keep their customers and grow their business, I mean, these are going to be companies that have something unique that is different. And the easiest difference, that you can extract in an economy, which goes back to what I was talking about, which is like, well, you can raise prices if your customers are starting to earn more, right? I mean, that makes sense, right? I mean, so if you have a newer company, I have a couple here, and I have a note so you can I'll provide all. You know what? I can do this. Like, yeah, I'll do this in a minute. If you're a company like Wayfair, for example, right? I mean, you sell furniture online. I mean, how many other companies sell furniture online? Like, I mean, there might be some, but at scale. Who do they, have largely as customers? Like, I know many of you might be from, Banyan Hill, ATG, because Wayfair, but I can tell you that, the vast majority of people who are used to going into a store and buying furniture, yeah, the idea of buying furniture online, yeah, not so attractive. So they generally draw a sort of a younger audience who is seeing their incomes and salaries rise. So they've got a unique offering that they can really, lead into. Now, they may not be able to raise prices per se, but they can take market share because their platform is digital. It's unique. It's different. They have a logistics system and a distribution system that makes them unique, which gives them an advantage over other furniture companies that don't have this platform. So they can now capture market share, keep customers, while the other one, yeah, they're subject to that cycle of, well, my salaries are rising, my costs are rising, and I got to raise interest rate. Wayfair, on the other hand, has a digital platform. That's what they buy and sell through. And that is far more efficient than, someone that has to run a large retail network of stores and is subject to all these cost pressures. That's quite different. Another example, for example, would be, I'm just going to put these stocks up so you can see. Yeah, I'm going to get to the other ones out there, like Shake Shack. Now, here is a difference. Like, I mean, I go to McDonald's from time to time. I'm sure some of you do, but my kids, if I give them a choice, my kids are 14 and 16. Yeah, they'll take Shake Shack over McDonald's. I mean, it's a younger product. They're slightly different. They're slightly different ethos. The branding is different. It attracts a slightly different population, and as a result, again, they may be able to lift prices a little bit without getting pushback. Why? Because their customer base is earning more money, and continue to see money. And so this is an example again, either because the product positioning, who they attract, these kinds of companies can do better in a period when, again, inflation, interest rates, incomes are rising for one group, but not necessarily rising for another group, all these different variations. Another example would be biotech companies, which have patents, et cetera. It's especially biotech. The regular old school companies have generics, but one thing that you can see is that the generics for biologicals work slightly differently, and so there's a higher level of protection for biotechnology companies. And so your CRISPR therapeutics, and your technology is so differentiated. The drug is very expensive to produce. It's very difficult for somebody to compete with you. You have a very unique proposition. Exact Sciences, has molecular-based testing. Very unique proposition. It's not just like a regular blood test that goes through things that can be copied quite easily. Here, these things are obviously patented. They require special processing, which is quite specific, and people just don't have that. You can't just throw up a plant and say, well, we're going to copy that. Very difficult to reproduce. The second strategy that I would pursue in this period, and remember, this live stream, not investment or financial advice, choose it, to use it in the best way relative to your personal financial situation, is innovation companies. Many people think of innovation as being like technology. Hey, I imagine that like, in its time, a barometer was like very high tech, right? But that kind of misses the point. I mean, all the gears and stuff in this were all very high tech, but the reason why this was adopted and put into every single ship in its time was because it provided a very valuable use to the captain and to the folks that were running the ship, which is that it gave them some ability to navigate the weather. Without that, all the gears or whatever, really, there's no purpose. So I think of innovation as this, like it's not some fancy technology. It's something that makes something that we do in our daily lives easier, more convenient, cheaper, more accessible. And then most importantly, it forces us to change our habits, practices. And in so doing, it wipes out incumbent companies and their technologies. In my notes here, I have robo-taxis. Now, many people be like, Paul, that's a joke. You've been talking about this for 5 years. There's no robo-taxis running around. Okay, that's fine. But I've been in Tesla since 2017, and I've always paid for their autopilot, full self-driving, whatever you want to call it. And the last update that came through literally 2 days ago, I think it's version 12.3. Now, this is starting to drive like a human being. I cannot say that, that this happened prior to this, because previously you could tell that there was very hard coding, which is like make left here. And then like, no, I would never do that. Like, it lacked some contextual judgment. It lacked situational awareness. But this one, yeah, I'm like, well, yeah, I could see myself making some of the same sort of like errors of judgment, but it drives like a person. And so we're like now, like, it may seem like science fiction if you've never been in a self-driving car, if you've never been in a robo-taxi, but as someone that's kind of like watched this technology develop now for 7 years, I'm like, whoa, this is, yeah, this is definitely where I'll be like, I can start to like, like see like, okay, robo-taxis are definitely going to happen. And the rate at which this gets better will be, will now accelerate because we've got so many more Teslas feeding in data, giving in situations that it has to deal with. And it's proven, the AI that's underneath this technology is proven. So obviously very unique, and you can, choose to believe me or not believe me. That's fine. Use it as a piece of analysis. But if you think through, like, assume that I'm right and that, robo taxis are going to work out, self-driving cars. Um, there are, it's going to disrupt, the transportation system as we know it. People will start investing for this innovation because the impact is so big. I mean, we transport ourselves by cars pretty much everywhere. And one of the immediate impacts that I can immediately see is that, like, I'm about to actually go to Austin to go see one of my favorite artists. He's this one man solo band, doesn't play very often. Super stoked to go. Uh, so I'll have to get to the airport, what, about an hour, hour and a half before, go through security, get on the plane, sit there. Obviously, it's 2 hours to Austin. Then I had to get off the plane, take a cab to my friend's house. I'm staying with him. Now that whole process, only 2 hours is flight time. The rest of it is all procedural to go through the airport. Now, obviously, I don't think I'm going to get in a car and go to Austin, so might not be the best example. But if I were to go regionally, so let's say Washington, D.C., or if I was going to go to Charlotte, which today I would probably have to debate between a car and a plane, or maybe a train. Yeah, in a robo-taxi world, this is a no-brainer. Completely, you would just walk into a robo-taxi and it would take you there. Why? Because it takes so much time to go through the procedural elements of all of these things, whether it be waiting for a train, waiting for a plane, security, all these, collecting your bags, waiting around, delays, weather. I mean, yeah, it is going to, first slowly and then suddenly wipe out, regional travel by air and potentially, by train as well. So unique innovation that really cannot be replicated, because Tesla's been working on self-driving for, yeah, the 7 years. I mean, so I'd say like 7, 8 years. They've gone through so many different, trials and tribulations, and they've finally hit upon this way using a neural network and AI. Nobody else is there. So it's going to take, I mean, probably like a decade plus for somebody to try and catch up. Nobody's going to catch up. It's not replicable. Um, Another example is what's going on in our financial system. Our banks, despite the assurances of the Federal Reserve and also our government, are in terrible shape. You may not know this, but they're in terrible shape. They made bad investments in 2020, 21, buying long-term government bonds that have like depreciated in value by 30 or 40%. So they lack money to lend. In addition to that, they have very expensive structures around their bank branches. Then they've got other assets that are in massive deterioration, which is commercial real estate. None of this is reflected really in the stock prices of most banks or financial companies. Why that is, I'll give you a quick explanation later. But the competition is here. It's not coming, it's here. It's in fintech companies like Block, which has the ticker symbol SQ. It's PayPal, it's Robinhood. You could even say it's Coinbase. And I know, the folks that are skeptical be like, well, Paul, PayPal stock is at a 5-year low. Hey, stock prices don't always reflect the opportunity set in perfect time. All right. You got to have a bit of a long-term view to get big gains. And that's been true for, all the companies that people are piled into today, Microsoft or Apple. It's not like everything happened like, in one year or 1 month or 1 week or 1 day. These are trades that develop over time. Stock markets can price in all kinds of different things. But asset values over time reflect the business and the opportunity set that's there. But Block, PayPal, Robinhood, Coinbase, these fintechs, I mean, they don't have these issues that the banks do. They didn't put all of their money into long-term bonds where their underlying capital has deteriorated. For them to get out of it, they either have to take a 40% loss, or they got to wait till these bonds mature in whatever, 10 years, 20 years, or in 30 years. So they're absolutely handcuffed. If commercial real estate starts to prices, which are, essentially are being held together by a kind of manipulation, which is that, the owners of the real estate are just like looking to kick the can down the road because the banks don't want to recognize the losses. Many of these banks are going to be essentially out of capital, and we'll have mini versions of the bank run crisis that we had. What was it? Was it last year? Yeah, last year with Signature Bank and all of these things. Um, these companies, yeah, they're not invested in commercial real estate, and their footprint is digital. They don't have bank branches. They don't have to, pay for real estate themselves. So they are far more efficient, far more, optimized for the digital world that we live in. I mean, effectively, you can use Venmo as your bank. You can use Cash App as your bank. You can use Robinhood app as your bank, and many young people already do. And the existing banks, if you go and look at their apps, because they're not digital natives, they're not grown up on the internet, using like sort of the internet for everything. Yeah, their apps, kind of like they copy what is done at the bank branch rather than looking to optimize the app for what it can do using the phone. These are all advantages that are going to be significant. And I believe that as we get into the environment of scarcity, um, there's not that many companies that really can replicate, what Block does, what PayPal does. Why? Because they, I mean, Cash App, which is, part of Block, they've got 50 million people on. PayPal, which owns Venmo, has like whatever 60 million people on. Robinhood has 30 million people. It's, they have now established like these, like, beachheads, if you will, which are going to be really pretty, I think, impossible at this point, really, to overcome. So that's the second category where I would be focused on in this period, which is like innovation that is true and scarce, and either by function of the business that they're in or actual technical innovation impossible to replicate. All right, the last one is something I talk about all the time, which is quantitative scarcity. One of the great defects of what I'll call fiat legacy money is that um, no one knows how much money has ever been issued of the US dollar or the euro or the Japanese yen or any currency you want to pick. No one knows at any given time how much is in circulation. There's no real way to account for it. And finally, no one really knows who has how much and when. Money transfers take whatever, anywhere from 1 day to potentially 3 days. There are some cases of instant, but it still works within like an old sort of like dilapidated plumbing system where it is not in the interests of the existing financial system to speed this up. Why? Because they earn float and they need the float because they're not making a lot of money lending. Their asset base is in trouble, so they really don't have a lot of interest in speeding this up. Contrast that to crypto, which hey, every Bitcoin ever issued, yeah, is accounted for. It's audited. It's making sure I get all the words here. It's public. You can go on the blockchain registry and see it. It's transparent. It's 24/7 accessible, both the record keeping, or you want to move money at any time. There's no bank hours, anything like that. And every coin that's been issued or transacted, is completely, trackable and knowable. The same is true for Ethereum and pretty much all, cryptocurrencies. And this is a step function jump in terms of innovation, in terms of convenience over fiat legacy currencies. And then finally, the convenience element, which is that I mean, try taking, in physical terms, cash, in a bag. I mean, heck, you can't even get. I think the restriction now is $600 a day of like the cash that you can take out from a bank. Anything more than that, you have to make a special request. So cumbersome, expensive. Try doing whatever, a wire, a money transfer. These are all expensive and time consuming. So here you've got, something that's, trackable. So it has scarcity. You know how much Ethereum has been issued at any given time. The same is true for Bitcoin. Now, going back to something I started with, which is that why are markets not positioned for scarcity? Why are they instead positioned for NERP, ZERP, LERP? Well, that's, in my opinion, is because Wall Street, which many people think of as like being some like entity that's like designed to serve you, what it is really is a merchandising operation. They are there to sell you investments and also sell you strategies. And so, in my opinion, um, folks have bought into Wall Street marketing and advertising. The first marketing pitch that people have bought into is that the recent past, which is NERP, ZERP, LERP, is going to happen again. And so position yourself in that way for everything that happened. Pick your time period between 2009 and 2021, and those same things. So you'll be piled into big tech or any of those scenarios. The second marketing pitch is that we're going to have a recession, which is also kind of a replication of the past, which is like we're going to have a recession, a crisis, or crash, and it's coming. And so you want to huddle into very large companies that are safe, dividend stocks, and so-called recession-resistant companies, which are all trading, by the way, at 30, 40 times earnings. I mean, they're like, hey, don't pay attention to that. Don't worry about that. It's all going to work out. You're paying, you're buying from us and we're selling it to you, but don't worry about that, and we've been waiting for this recession now for what, like I think close to 3 years, and no recession is coming. Why? Because between the government's debt and pumping extraordinary amounts of money into the economy and the financial system, and all of the things that the Federal Reserve did from 2008 onward until quite recently. I mean, there is so much money in the system, right? That even after the Federal Reserve has lifted interest rates from 0 to 5.3%, the S&P 500 all-time highs, real estate markets, still at highs. I mean, the activity in many of these things has gone down, but the prices are at highs. Why? Because the critical factor in certainly crashes and crises is leverage, which we have. There's a lot of debt, but there's also a lot of cash. So when money needs to be rolled over, there's enough money out there to kind of keep prices doing this. So expecting a crash, I don't think we're going to get a crash. Why? There's so much money in the system. All right. The third marketing pitch is probably one that I'll get into trouble with because there's big fans of these stocks out there. But hey, listen, reasonable people can come to different points of view. And if you have a different point of view, that's fine. You don't need to troll me. You're entitled to it. I've had people tell me, Paul, you missed this trade. This is why, you're. The third marketing pitch, is probably the one that many people are in, which is that to buy chip stocks because of artificial intelligence. Yeah, I mean, hey, I want to tell you, I think artificial intelligence is absolutely real and is going to be absolutely huge. But I really believe that it's unlikely that the chip stocks that everybody's very focused on, NVIDIA, SMCI, what are some of the others? I mean, those are probably the two, are going to be like the ultimate beneficiaries of this. Look, folks, I was around in 1999, 2000 when something like that viewpoint was marketed to folks about the internet. And you can see that, I mean, the companies that benefited from the internet, really, many of them really got going in 2001. I can't remember when Google came public. I think it was 2002 or 2003. And Microsoft did okay in 1999, but it crashed after. Apple was not really a huge beneficiary of that stock market boom on the internet. So that's why people are positioned the way that we are. All right, that is my live stream for today, which is like, hey, something big happened. Even though it doesn't seem big, it's big. And it's going to matter with each day, week, month, and year, which is that it is now 100% clear in my judgment, in my opinion, that we're in an era where, the interest rate cycle is going the other way. There can still be good periods of asset price increases if you are focused on the future rather than the past, which, I've laid out, which is like, a period where you focus on the scarcity either of the opportunity or the asset, or growth is going to be scarce. You're going to focus on scarcity, and there will be periods when these assets really are in huge demand and will get bid up. So it doesn't mean like everything is lost and everything's there. The other thing that I'll say is that people expecting a crash aren't likely to see it. Why? Because there's so much money in the system. Finally, why are people positioned the way that they are? Well, hey, the greatest advertisement to get the general public into any investment is to keep the price high. Because what do we really want in the end? We want gains. We want gains. Give us gains, right? Give us gains. If you keep the price high, you look in your account, yeah, you don't notice it drips down 2% a day. You're like, it's fine, it'll come back. And there's different ways in which you can lose. I believe this one is going to be a drip, 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 drip. So that's what my viewpoint is on this. Let me now go through the comments. I want to recognize Pulverizer, who is no longer making comments because I said once that he's our most enthusiastic contributor. I really recommend you continue to contribute as much as you can. It helps with the conversation. It also gets other people to open up and to also give their perspectives. Yako says, love your perspective and research, but my 100x portfolio is down 70%. Yep. Yeah, it can happen. These are risky stocks. You're not guaranteed to make money. Not every stock is going to go up. There are stocks in that portfolio that have gone up. We no longer have that portfolio by itself. It's called the diamond tier. We've sold a lot of those stocks because those were selected in a period when interest rates were at ZERP, when the interest rates hadn't gone up to 5%. We were highly focused on COVID. That's not the world we live in. And that's, you are not guaranteed profits. You're not guaranteed 100% profits. Scenarios can change and sometimes dramatically. And we have to, invest for the world that we're in rather than the world we wish to be in. Joanne says, how have interest rates been affected in election year? Yeah, this is a pretty short-term timing thing. The Briggs cycle is much more important than any election year. If you go back and you look, I mean, maybe in any given year, people can argue that interest rates are kept low or kept high to help a president or to help a party. In the longer term, it's never been shown to matter. Heng Lao says, you got fired. Yes. I mean, yeah, my contract was terminated, and that's why, I left, was, forced to leave Banyan Hill. My contract was set to expire at the end of 2020. Wow, time has passed. At the end of 2022, instead, in the process of my contract negotiation, they said, yeah, we don't want to, have you anymore, you and your team. Yeah, I wasn't necessarily in control of the communications at Banyan Hill, so I couldn't necessarily tell subscribers, well, it's there. So at the time, I had no real plans, being terminated. I was like, well, I'm just going to hang out. So I said, well, I'm retiring from Banyan Hill. But I mean, my contract was terminated, and that's the event that catalyzed the creation of ATG Digital Media. Regarding the AI, Raul says, regarding the AI craze, you see a company that stands out just like Amazon did 30 years ago. I don't see any single company by itself because the world is just much more disparate, dispersed. Instead, I believe there are going to be a lot of different silos because AI depends on data, and then you got to parse the data in a particular way to come up with analysis, and then you have to be able to use that analysis to affect decision making that creates value. So this idea that one company is going to dominate AI, I think is false. I think instead you're going to have many companies dominate various different niches is where I believe the AI opportunity sits. Yako says, I love the ideas today and agree with them. But what about the current market topping you suggested in relation to today being like 1990? Seems like we should wait to act on anything else. Yeah, I don't think that's right, because one of the subjects that I've raised in my updates in ATG Digital is this, which is that the nature of our media and markets has shifted a great deal. Through most of my career, you would get your viewpoint on the markets from two or three ways. I'd say most retail, regular investors, individual investors would look at the indices and be like, I'm afraid, I don't want to buy, or I'm going to sell. And you look at the S&P 500 and you'd look at the Dow. The Dow was it for a while. Now it's the S&P 500, to some extent, the NASDAQ 100. And then you would look at like maybe 5 news sources: a Wall Street Journal, Financial Times, New York Times, maybe a couple of other like, publications. But today we live in a world of like mass dispersion of media. I mean, like I have not read the Wall Street Journal in a few years. I mean, I get almost all of my information from X, Reddit, uh, some Substacks. So we're no longer in this what I call a monoculture of like the index is down, I need to sell all my stocks. People are not behaving that way anymore. Why? Because the nature of the way news is dispersed, the way information is dispersed has changed, and people are less willing to go with like, oh, some central point of view that Wall Street, investment banks, market makers can sort of manipulate. So it's like become harder. The second thing is just the amount of money in the system. Like, I mean, we went through in 2022, where some people panicked, but at some point in time, even during 2022, there was still stocks that were going up. In other words, you could see that dispersion effect where if some stock was being talked about on Reddit or on X, people still came in and buy it. And if you were tracking sort of sentiment on X, it was never got that down. And that, I believe, is a major shift in terms of how markets work. We're used to thinking in that old way, which is like, some central point of view affecting what people do. Now it's much more diverse. MRG says, aren't innovation stocks directly related to interest rates? No, I believe that is the marketing around it. I believe that in a zero rate environment, many innovation stocks were focused on the idea that, at 0% interest rates, it made perfect sense, economic sense, to go after every single opportunity. Why? Because, well, there's no opportunity cost. I mean, people are willing to give you money. Why are they willing to give you money? Well, rates are zero. They're willing to give you money and like go pursue every growth opportunities out there. So, of course, as the Federal Reserve went to raise interest rates, many, I'll call, businesses were sub-optimized or unoptimized for what, a higher interest rate environment would demand, which is like, you got to show me profits, you got to show me cash flow. But it has now been 3 years. Companies that are in command of, the kinds of businesses that I've laid out, I mean, they've all pivoted. They've all pivoted completely. I mean, they've cut projects down, they've cut staff down. You go read their quarterly earnings. They're focused on producing profits, cash flow, reducing the number of shares that are being put out there. Yeah, they totally get it. So this idea, that like these two are like somehow like fundamentally connected. No, people behave relative to the incentives that are out there. And so in a zero interest rate world in the United States, people pursued, unlimited opportunity. Why? Because the cost of capital was free. When cost of capital is much higher, now you're seeing much more selectivity. And people focus on, it's like, hey, we got to generate, our own money. We can't like keep putting our hand out to the market and saying, hey, give us money, or to investors and say, give us money. MRG says, look at a chart of ARKK, proxy for ATG versus TLT, closely linked. There's little incentive to buy money, losing innovators. Yeah, I would say you're not tracking the companies. Companies are making money. They're focused on profitability, and you can see it if you're tracking these companies on a quarter-to-quarter basis. There's a major shift in the character of these companies. Yaka says, shouldn't we wait until 2026 and sit on cash? I doubt it, but each person should decide for themselves. If I'm right, I see a transition unfolding even with each day, where we can see various biotech companies being bid up. You can obviously see crypto-related stocks being bid up. And I believe there is a transition unfolding, and people expecting like, old school, hey, everything will get crashed and then you'll get to buy. I don't think the world ever works out that conveniently. It's always something that requires you to, put yourself in some little discomfort that like generates, the big returns. Your research is fascinating, but the portfolio doesn't reflect the reality of higher inflation. Many of the names were also purchased much, much higher. But you can go purchase them lower. I mean, you're not locked into place. In fact, I mean, one of the things I made a point with somebody that, raised a question, because I've been selling and rebuying things after 30 days. And somebody said, this is window dressing. I said, fair enough. But like, hey, would you rather experience as these companies go back up first to their old high? Would you rather experience that as a gain or as a lesser loss? Well, I mean, most people prefer to experience as a gain. So sell it and buy it at a low price. Nobody's stopping you from doing that. I mean, SMT says, is Momentous still a good company? This is probably the most speculative stock we have. It is in our silver tier portfolio. And in my last update, I was like, that I covered Momentous, I said, well, I mean, they are clearly running out of money. I mean, I think they have $2 million. But at the same time, there's very unusual things that are going on that make me like wonder, like, like, well, what is going on here? So like, in the last 2 months, they've gotten 2 contracts from NASA, right? I mean, they're not large contracts. They're like for $1 million, but for, a company that's struggling for cash, I mean, any money being given is a big deal. And so, I mean, I've essentially said, look, I'm committed, being that, we put this in with, big hoopla at Banyan Hill. I'm committed to keeping this in the portfolio, tracking it, providing updates on it. And it's either going to be the greatest turnaround in history, and, and it will turn, and, their water-based, propulsion technology, which is, the basis of, my investment in it, which is revolutionary. If it turned out, to be a big thing, yeah, this, could be, I mean, when we bought it, it was what? I think $1 billion company. What is the value of a company that has a revolutionary technology that can work in space, that uses water? Yeah, I mean, I think it's probably worth, well over $1 billion. So let's see. I mean, it's either going to be, the greatest comeback in history, or it's going to be a bust. Is it a good company? You'll have to decide for yourself, given those choices. Raul asked, part 2 of AI question, who would be the leaders in the niches you know about? Good examples of this are much smaller companies that are just emerging. For example, one of the places where you can really see a role for AI, for example, is in customer service. And there is a company called TaskUs that is, global. They've got all of the data on customer service, and they do customer service for Coinbase, and I can't remember, many major companies, because customer service is a critical skill that requires a very particular technology stack today. It's not just like old school, like, okay, seat 4 people down, have them answer phones. It's very critical to every company, but it's very specialized. And to implement AI in customer service, well, you need to be an expert in customer service. And so this is going to, end up being a niche that is going to be dominated by some, like a company like TaskUs or someone like it. So this is an example of what I mean. There's going to be these, like, these niches. Yako says, I'm only talking about 2026 in relation to the 1999 relation. I do think crypto will continue the 4-year, Bitcoin will crash. Well, everyone has a point of view, and you are, you could be right. My view is that, Bitcoin, based off the halving and everything I've said in multiple YouTube videos, Facebook Lives, updates, I think, we're headed for much, 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 have I said much enough, higher Bitcoin price in 2024. All of my research says that the peak comes about 18 months after the halving, with big whales like the Bitcoin ETFs, MicroStrategy. There's some wallet called Mr. 100, because this person, company, organization, country, nobody knows, is buying like 100 Bitcoin a day. Yeah, 100 Bitcoin a day. I mean, just like day after day after day. So I've theorized, like, we're not likely to see as much volatility as in previous cycles. Time will tell. Time will tell. Anyway, thank you all for attending. Thank you for your questions. Come back next week, and we'll have another one. And subscribe so you get a notification. ATG Digital Media, if you want to have a subscription to ATG Digital. ETF buying will slow down, already is. Yeah, one day does not make a slowdown. I mean, you can look at the chart. I can put up a website, will show you, I mean, on average, Bitcoin ETFs are buying between 6,000 and 8,000 Bitcoin per day. Louise says, your GBC portfolio, I note that you have stocks listed that you've sold in other portfolios. Please advise. Yeah, I mean, we have been trying to start a ETF business. And so I created an index starting right about the time we started HEG Digital, called what I call the Growth Blue Chips 100. One thing about an ETF that allows for is that, you don't have to react to the volatility because, with our, we've got the silver tier, which is like multi-cap. We've got gold tier, which is sort of like mid to higher small cap. Then we have diamond tier, which is small to micro cap. I mean, we can only carry a certain number of stocks, and we have to try to obviously generate performance in something like a reasonable period of time to keep our subscribers happy. So things that are there, we can give it a little bit longer leash because people are not focused like, hey, Paul, this stock is down. Instead, when you're like, if you're buying a GBC 100 ETF, you're just focused on the ETF. But if you subscribe to diamond tier, you're like, Paul, 7 out of the 10 stocks are down. So in an ETF, you can have a longer term time frame. You can keep things in there and be slightly less reactive. So the stocks that are in there, they were, if we've sold them out of some of our tiers, it's because we still think there's a possibility that these could be good stocks, and we'll come back to it when whatever the timing is right or something like that. Paul says, thanks, Paul. Appreciate your point of view. Harrison Smart says, Tezos buy or sell. I mean, we have Tezos in, I want to say it's our diamond tier. I have come up with a viewpoint that is, I mean, I think for the people who own Tezos, it's not unique, which is that, they have a purpose, which is that they are the blockchain for people in advertising and art. And so there's not many blockchains that can point to a specific purpose. So if that's right, there is an entire chain that's going to unfold, which is that there's a reason for people to own Tezos, which is, to earn money in Tezos, which then they store it, then they use it to buy art, create art. So there's like this network effect that is there when there is a purpose. So that's my viewpoint on Tezos. And I'm going to end this here because we are now 1 hour into this live stream. Thanks for all your questions. Thanks for all your comments. Subscribe and then come back again next week or the next time I post a live stream. Bye, everyone, and thank you.